Well, welcome everyone. In case you don't know, I'm not Alex Johnson. Um, I think he's a little bit taller, actually probably a lot taller than I am, and has red hair. There was meant to be five of us on this webinar today, but unfortunately, um, Alex came down with a stomach bug. So I will do my best to do the moderation that he was going to do. But we do want to welcome you all. We're really excited about bringing this webinar to you all. I think this is a very hot topic within the FinTech Bank partnership space, and we've got some experts to really dive deep into the details of subledger management and some of the best practices. And we'll go into detail on the proposed rule from the FDIC, but then we'll also talk about just some general best practices that, as an industry, I think we should all be pushing for. So with me, we've got a number of as I mentioned, esteemed panelists. So we'll kick it off with Dana, if you want to introduce yourself.
Sure. Hi, everybody. I'm Dana Weinstein, and I'm a product manager at Plaid for our transfer product. Previously, I built payments products at Visa and Orem, and I started my career in community development finance in Washington, D.C.
And Koji, do you introduce yourself?
Hey everyone, I'm Koji. For the past 3 years, I've led the Ledgers product at Modern Treasury. And at Modern Treasury, we're building the payment operations platform for the instant economy. So that means we partner with banks like Cross River to enable our customers to build products across fintech, payroll, lending, a whole number of different industries.
And just to introduce myself, so I'm Keith Vanderleest. I lead the payments team here at Cross River. Happy to be here with our client Plaid and a partner in Modern Treasury. I've been at Cross River 5 years, almost 5 years. Prior to that, I was at American Express, and prior to that, First Data, and started my payments career at Western Union. And we'll talk more about what Cross River does within FinTech in a little bit. But Kia, let's turn it over to you. Introduce yourself, and then why don't we kick it off and start talking about this proposed rule from the FDIC.
Yeah, Keith, thanks so much for joining me, and thanks for Cross River for holding this. I am Kia Haslett. I am the Banking and FinTech editor at Bank Director. I've been here for about 5 years, and before that, I was at S&P Global Market Intelligence on their financial institutions coverage team. Importantly, I'm not an attorney, so if you have questions about this rule beyond this overview I'm going to share, I encourage you to speak to both consult the rule itself and to speak with an attorney. But just to kind of ground ourselves in this conversation, why this, why now? It's no secret that technology partnerships and fintechs have really changed how banking services are delivered to end customers and the role that banks play in this space. But that's also led to some challenges into the administration, reconciliation, oversight, and now the wind down of some of these partnerships. This reconciliation rule and record keeping rule was proposed by the FDIC in their September meeting. It comes as in response to some of the challenges that companies have had when winding down these partnerships and trying to disperse funds to end customers. And the FDIC mentioned that they are concerned about the accuracy, integrity, and completeness of the financial records of these accounts. And the role that transactional custodian accounts are playing more broadly at banks. This rule is intended to help the FDIC make insurance determinations in the case where a bank would fail, but also the records could be used in situations where a bank doesn't fail, but the fintech partner or the company that is administering the custodial account fails. Just better records would probably make a couple of things a little bit easier. So the rule would apply to custodial accounts with transaction features. Broadly, that is defined right now in the proposed rule as accounts that are established on behalf of a beneficial owner. The account holds commingled deposits from multiple beneficial owners, and the beneficial owners of these accounts can direct through the account holder transfers to other accounts at other counterparties. So basically that the beneficial owner, the end customer, can direct the account holder that opens the account to make a payment. That's a pretty broad definition. There are 10 account types that are already proposed to be exempt, including HOA, trust, and government deposits and reciprocal deposits, either because these transaction accounts have very limited transactions or have separate record keeping requirements. The rule would require banks to be able to identify for each custodial deposit account the beneficial owners within that account, the balance attributable to every beneficial owner, the ownership category in which the beneficial owner has the funds, and there would be a specific electronic file format for the maintenance of records of the beneficial owners that would be required regardless of whether the bank maintains this record itself or collaborates with a third party. Comments on this rule are due soon, 60 days since September 17. The notice for proposed rulemaking says December 2nd, and there has not been an extension on this rule yet. Now, obviously, we cannot talk about this rule without mentioning that there was a presidential election that may change the direction and leadership of the agency that has proposed this rule. The chair could shift. It is expected that the board composition will shift. And the members of the board will shift, potentially including with the CFPB and the OCC's seats on the board. Davis Wright Tremaine, in publishing a summary of potential changes, writes that the FDIC could elect to revise or to review this rule as part of just figuring out where the new agent or the agency's new direction should be. They could take a systemic review. They could decide to cease rulemaking on this. So participants on this call could anticipate slower rulemaking on this proposal, a modification of the proposal itself based on comments that are due December 2nd, as well as the direction of the agency. And of course, the FDIC could decide not to pursue rulemaking. Now, I have a couple of thoughts on this, and I just want to say, these are my thoughts, these are my opinions. This rule, when it was proposed in September, did receive the full support of the board, including from the 2 Republican minority board members, even if their support came with some qualifiers. Another thing to know is that in the proposed rule, the FDIC says they don't have good data on how many banks have these types of accounts, and they estimate that between 600 and 1,100 banks may have accounts that qualify. I think this is a pretty serious disclosure that the FDIC is looking at a situation in which between 600 and 1,000 banks have partnerships that may be difficult to wind down in the case of a failure or in the partnership's bankruptcy. I also want to say that I don't think it can be said enough how serious it is that we have seen the harm that can come from not knowing whose money belongs to whom, from not knowing how much money an institution should be holding on the behalf of a fintech partner, and that the industry, the fintech industry and the banking industry risks high reputational risk from people just not understanding if their money is safe. And this is a problem that I hope this rule can help address and help people feel comforted by. And I believe the industry that is active in the fintech partnership space should also want this longer term. I also believe that the technology is able to help institutions and their partners with this rule. Developing a framework, governance, and discipline with banks active in partnerships can help them become more sophisticated and mature and better partners overall. And to that end, Cross River's founder and CEO, Gilles Gade, came out in support of this rule by calling it absolute but reasonable and balanced response from the agency, and that no bank should enter into a relationship with a fintech without complete control over all activity, include maintaining the ledger. He said that it's worth this in-house technology investment. So Keith, I think we're about to talk about one of the options available to banks as they think about compliance with this rule, and also just how they can be better partners in making sure everyone gets the money that's owed to them.
Yeah, thank you for that background, Kia. And I think you hit on a couple key points. One, most importantly, banking is about trust. And to your point around reputational risk, if banks who have earned the trust of end users, whether those are consumers or businesses, are sacrificing that trust on behalf of fintechs. Like that's a lose-lose for both the fintechs and the banking industry. I think everyone on this call has a vested interest to ensure that trust in the financial system continues to grow and expand and doesn't go the other direction. So, encourage everyone to read the rule, make comments, and really understand, the various different obligations of both a bank and the fintech within the ecosystem. I don't think we should, go to a rule. We're all smart people. We should be able to figure out, what is the best scenario for handling customer funds and what types of money movement is happening within an account or within a fintech ecosystem. You commented about what Crossover does and what our CEO has talked about. We run our bank core, we call it COS, with subledgers. We built COS back 5 years ago when a very large client of ours who needed to have visibility instantly to wires as they came in. It was a crypto exchange, back then the price of Bitcoin wasn't what it is today, but the same scenario, understanding in an FBO account whose funds are coming in and how to allocate those funds appropriately. So we created COS, it's API first bank core with subledgers so that our customers could identify whose funds those are. That was 5 years ago, and the importance of subledgers have increased even more so. More recently, with many of the consent orders coming out around BSA/AML, we've seen a lot of value in subledgers within FBO accounts to identify suspicious activity from a transaction monitoring perspective. With that, we've tied in customer records to those subledgers so that we can see different profiles of customers within that pooled omnibus account. I think it's also important to note that within FBOs, there's different types of relationships. The majority of the FBOs that we're talking about, we are not forming their payments partnerships. We are not forming a direct relationship with the end user. That is very different from a BAS program or some of the debit card programs where the end user is becoming a customer of the bank. I think that nuance is very important to understand. And of course, there's a lot of different gray areas when you talk about issuing, you talk about different features of a subledger versus an account. And with technology being what it is, I think there's the potential for the lines to become very blurred between a subledger and an account, because if the subledger is fully routable, meaning it has its own account number, that may be perceived as to the end user as a standalone account. So it is to all of our benefits to make sure it's very clear to the customer, the end user, when they're getting an account versus when they are simply having a wallet or the funds are not theirs in the FBO, they're moving through the account. It's pass-through model. But with all of that said, I think, Dana, from your perspective at Plaid, how are you all thinking about subledgers and the impact of this rule within the fintech ecosystem? Obviously, Plaid is well known from a data perspective, and you've got most fintech clients as your customers. So we'd love to get your perspective on this.
Yeah, thanks, Keith. So Plaid's mission is to unlock financial freedom for everybody. And as you mentioned, many people know Plaid best for our account linking capabilities, which are facilitated by our network of banks, 8,000 fintechs, 12,000 banks, and over 100 million consumers who've linked an account with Plaid. So from a data network perspective, we're the leading provider in the industry, but we're also obsessed with making actual money movement easier and safer for our customers, and doing that in a way where, again, we build trust and we reinforce trust. So Transfer is our end-to-end solution that helps fintechs, platforms, and billers seamlessly and securely process bank payments. These customers come to us because they can't or don't want to custody funds themselves, and they're often using our account verification and payment risk products, and they want, again, an easy end-to-end solution to implement. And the type of model that we operate uses an account structure that we think would be subject to the new rule. So we're super glad to be partnering with Cross River as one of our partner banks for Transfer, because your capabilities support our ability to offer a product that has the level of transparency and security that is really critical both for us and for our customers. And there's a few concepts that Kia mentioned that I think again could be a little bit sort of hard to imagine. Like, how does that actually all work in practice? Like, what does that really mean? What's a custodial account? What are these transactional features? And so just kind of a few points about that, and especially kind of how it works in the Plaid model. Unlike in a lot of banking as a service, situations, as you mentioned, for Plaid Transfer, we're not opening a brand new separate bank account for every single one of our customers when they board with us. Instead, we're utilizing kind of the same omnibus account for our customers' funds. And in fact, this account is custodied by Cross River. So it's also known as a for benefit of account. You mentioned that term, Keith. That means that Plaid's not even taking possession of the customer funds at any point, right? The bank is ultimately the entity that holds the funds. But even though there's only one physical account with, customer funds commingled in it, we are absolutely huge fans of Cross River's Subledger management capabilities, because that allows us and customers and Cross River, everybody to know at every step along the way how much in funds is allocated from, $1 million. Who does that $1 million belong to, right? How does that get broken up? And precisely because our customers are coming to us for payments, right, for those transactional features, it means everybody can understand at any point how much money do different customers have, and can they safely transact knowing that every penny is accounted for along the way.
Nice. Yeah. And Koji, let's hear from you. Give us a little bit more detail about what Modern Treasury does with various different banks, and your view on ledgers within an FBO.
Yeah. So I think just to take a step back, let's keep in mind that the FDIC's goal is to protect consumers. So if the fintech goes out of business, the FDIC is the one that has to come in, make sure consumers get their money back. So to them, at the end of the day, they just want to make sure the bank knows who the money belongs to. And the FDIC actually describes a couple of possible patterns for maintaining the subledger. One is the bank maintaining it from end to end. The other is the fintech maintaining a subledger that either they've built themselves or bought from a vendor like Modern Treasury. So I think things are pretty straightforward if you can work with a bank like Cross River that has routable subledgers out of the box. Historically, in practice, this hasn't been the case with all banks. And so some fintechs also might be working with multiple partners across processors or banks. And so the pattern that these companies would follow, that the FDIC allows for, is the fintech maintaining their own subledger and reporting it to the bank. But what we found a few years ago when we started doing this is building your own subledger is really complicated and risky. And the FDIC also imposes certain requirements around the bank needing to have direct access to a copy of the subledger, being able to audit it. So I think while building your own is something fintechs do today, we'll see more companies moving away from it over time. And that's a part where Modern Treasury often slots in, is when companies think about doing that.
Yeah, what do you think about the fact that, there's lots of different banks out there, and I think every fintech should be thinking about multiple bank partnerships, and the capabilities, as Koji mentioned, of different banks varies. And overlaid on that, you've got many different flavors of fintech programs. We talked a little bit about BaaS versus payments, but FBOs could be used in many different ways. How do you how is a fintech supposed to understand the right way to do it, given the fact that they're not having direct conversations with the FDIC? It's all coming through their bank and some public, comment letters like this or proposed rules. What is a fintech to do here?
I think there is a lot of soul searching that probably needs to happen throughout different types of bank partnerships. And for fintechs that take deposits, I think they really need to understand the role that they play in interfacing with end customers who, and the use of the FDIC logo on the website. And can we ever disclaim away the relationship between me, the fintech, the intermediary, and the end customer? The other thing too is, maintaining that ledger, I think has, become so important, because even if the FDIC wouldn't necessarily step in and help resolve a fintech, at least what we're seeing with Synapse, the FDIC has said that it's received more than 1,000 calls from customers whose funds have been tied up in a bankruptcy proceeding where, naturally the funds would be frozen, but the reconciliation to get those funds out to disperse customers is taking longer than I think anyone thinks is ideal. The FDIC is extremely good at closing banks and reopening them on a Monday and making sure there's minimal interruption when a bank goes into bankruptcy or when a bank fails, and that doesn't exist for fintech. So that wind down, the ability for the fintech to give the bank partners and the bank partners to show the FDIC, we do know who this money belongs to. We're going to disperse it as quickly as possible. There is no concern for consumer protection harm here. I think is really important. But I do think that some of these BaaS programs that do involve deposit taking will need to think really, really hard about the type of ledger that's going to work for them, given, whether they have multiple bank partnerships or whether they're kind of working through some of these intermediary third-party middleware platforms, or maybe working more directly with a bank on their platforms. But I think this is honestly like an open question. I don't think this rule puts a stop to us thinking as an industry, what's the best way to arrange these partnerships?
Yeah, I think it's something that has a lot of gray area, and I've appreciated the ability to, the FDIC doesn't know how each bank operates, and it is very much down to the bank to help the FDIC understand how they're operating their programs and then what types of programs they're under. And I think all of us would benefit from, high level guidance with enough flexibility to allow for innovation and kind of newer fintech programs coming out, and then newer forms of money movement, newer forms of payment. Koji, maybe to that point we were talking before about the pace of innovation. We've launched RTP, we've launched Fed Now. I know Modern Treasury is doing a lot of that, also Plaid. Would love to get both maybe Koji and Dana's perspective on, what does faster payments mean for the legacy idea of, let's say, daily reconciliation, and how is fintech going to manage that?
Yeah, I think this topic gets really interesting when it comes to real-time payments. So as a reminder, the US has really been pushing adoption of real-time bank payment networks like RTP and Fed Now. And we're behind a lot of other countries on this, but I'm convinced in a few years we're going to see a large portion of the payments that are happening over ACH and wire, these older systems, moving to real-time payments. And this changes the way reconciliation and subledgering happens. So, by the way, Cross River has also been ahead of the curve on real-time payments. We have mutual customers at Modern Treasury who've adopted RTP. But if you look at the language of the FDIC ruling, they talk about reconciliation. And they talk about it more in kind of the daily reconciliation fashion of, today most payments happen kind of on the daily cadence. Payments are processed. You check at the end of the day, do my user balances line up with the transactions that have happened? But in an RTP world, payments happen instantly, not on a daily processing schedule. So that means you can actually do real-time reconciliation. As soon as a payment is executed, you can check, does my bank balance, does my user balance line up with that payment that's happened? And that's going to totally upend the way companies do payment operations and reconcile against what the bank's telling them. I think to get more concrete, one-way cross-river makes that easier is you get real-time balance webhooks when you execute a real-time payment. So that means that you can actually double check, okay, this is what cross-rivers told me about what the balance is. Does that make sense based on what I've seen on my end as the fintech?
Nice. Dana, what's Plaid's perspective on
Yeah.
innovation and how this rule
Yeah,
might?
I mean, everything that Koji said really resonates with us as well. Because as you can imagine, again, our customers want to know and need to know that they have, funds available in order to kind of send payments out of the account, right? And many of our customers are issuing payouts, right? They're kind of running a payouts program, or they have a, important flow of funds that is payouts focused. And so the subledgers become especially, which they in fact then turn around and use to issue things like RTP payouts and FedNow payouts. And so even from our perspective, the fact that, we have subledgers that can track all of those different flows of funds and get updated in real time, again, with the bank, means that, we have a lot of customers who are inbounding funds to the FBO account to kind of build up a balance, right? So they can do their payouts, and having that real time reconciliation. So when a wire lands at the FBO account, or if they're pushing even, an RTP to the account, those funds are updated in real time at Cross River, at Plaid, and then out into our into the dashboard for our customers, into the reporting that's available to them in the webhooks that we send to our customers, which means that, as soon as the funds have kind of fully moved through the cycle, everybody knows exactly where the money is, how much they can spend or not spend, how much they've spent already, right? If you're doing high volume of RTP payouts, you can be moving a lot of money in a very short amount of time. And so, when we think about running a payments program for our customer, it's not just as simple as queuing up like debits and credits, right? If we could do that, if that's all we were doing, we wouldn't, no one would pay us, right, for our product. We really see the importance of supporting a customer's full life cycle and kind of the full complexity of their business growth. And so one of the things that we've actually launched as a new feature recently that sits on top of this subledger capability is our kind of multi-ledger balance feature. So, before we were talking about kind of one ledger balance, one customer, one, Plaid transfer customer. Now we can even talk about, different customers contract different flows of funds that they might have, again, within that same omnibus account. So again, if you have a payouts flow of funds, if you're a lender that operates in different states and wants to track that differently, if you're an investment or a brokerage platform and you want to track your different assets differently, like you can do that now. We've made that really easy in the dashboard via API. And again, that is recognized and reconciled from the customer to Plaid to Cross River, potentially as the FDIC one day. And we're, super glad that kind of all of the payment activity, money flowing into the account, out of the account, is tracked and visible at every step of the process in real time, and not just once a day at the end of the day.
How do you, and just throw this out to the group, I've got an opinion, but open to everyone's thoughts on this. The maybe more so for existing fintechs who have been operating maybe without subledgers or not quite seeing the value of subledgers, fully routable subledgers. This may not be directly tied to a revenue initiative for a fintech. They might see it more as a cost. How do we think about the business case here for, I mean, both fintechs and banks? How do we draw the correlation to, what is the business case? How we're going to generate more revenue? How we're going to manage expenses? What are everyone's thoughts on that?
Yeah, I'm happy to take a stab at that first. What I would say is that I can tell you, from the feedback that we're hearing from our customers, that being able to reconcile clearly and cleanly and easily, and be able to kind of demonstrate, flows of funds in a sort of separate but aggregated way is actually mission critical for customers from a kind of FinOps perspective. They have their own, internal stakeholders. It could just be internal finance. It could be their auditors. They may be operating in a regulated space. And so really anything that you can do, from transfer and Plaid's perspective, anything we can do to kind of facilitate that record keeping and that segregation in a really easy to understand and accessible way, again, helps our customers not just, move money, right, debits and credits, but actually run the business kind of from end user onboarding to, again, account linking, payment risk assessment. And then once you've actually moved the money, like a lot of customers think, oh, it kind of stops there, right? I launch an ACH debit or an RTP and like, that's it.
Yeah.
It's only just begun, right? Payment
Yeah.
operations
Yeah.
just begun. The more that we can do to kind of report back to customers and help them understand, again, full life cycles, track everything at a transaction level and a balance level, and close their books faster, the more successful they are on our product. That's how we're measuring success.
Kia, I know you talk to a lot of banks and fintechs, but probably more banks than maybe some of us. What's your perspective on how banks are thinking about this from a cost perspective and what the investment might involve?
Yeah, this role comes at a really interesting time in the banking as a service eras or waves for community financial institutions. I think that we're seeing for many institutions a reevaluation of how much they want to play in the banking as a service space, and more articulation around the necessary technology stack that is required to meet regulatory expectations and to offer a great product, and then the subsequent cost and the amount that needs to be charged to any customer or the revenue that needs to come from any program. And, I think there are banks that are looking at some of these rules and are deciding this is not actually how much money they were hoping to spend on their programs.
Yeah.
This is not an amount of investments that they are looking to make, and that they are going to opt out. And I think, honestly, any clarity a bank can have around exactly what is expected for them to run a compliant program, and what is great, whether or not that program is profitable. But that at the same time, there are many banks that are deciding that this is something that they want to be very serious about and are looking to make appropriate investments in order to have really great partnerships and to price them appropriately. The other thing too, and I can't say it enough, banks really need to be communicating with the FDIC about the amount of money
Yeah.
that are in these accounts in the case of their failure. And I know that many banks do not actually want to think about what would happen if I failed and how many uninsured giant FBO accounts do I have in my bank. But one of the really serious problems here is that these are very difficult accounts to pass to another partner, an acquiring bank in a failure. And I believe it would be completely unacceptable if a large BaaS bank failed and giant FBO accounts only got $250,000 in insurance coverage, which is the only amount of coverage the FDIC could pay out if the records are not kept. I genuinely think that, if we think about the direction of banking and the direction of technology, I don't think every bank should be a BaaS bank, but I think the technology stack and the ability to reconcile daily, to track your transactions, to have more knowledge about your customers is something that banks need to be thinking that they should get better at, and the expectations are you get faster at. So whether or not you're a BaaS bank, whether or not you pick subledgers as the way that you monitor these accounts, I would hesitate that any bank should opt out fully of this role or of the objectives of this role.
Well, and it's this rule, and we could do a whole webinar on the broker deposit rule. Now
I
there's
think
open banking.
I think that rule is getting maybe revisited in the next administration.
in the new, yeah. Well, right, like in just when banks think they're going in one direction, and now I don't know what direction are we going to go in, what's going to happen. I think what we found as a bank, and I think this could apply to both banks and fintechs, and there's always room for improvement, right? But from a business case perspective, the way we think about it is not only is this the right thing to do, it can be profitable. When we think about the subledgers and the use of subledgers, not only for maintaining balances, but understanding who the fintech's customers are, who the end user is. I mentioned BSA/AML. Obviously, there's been a lot of consent orders around BSA/AML. It is a huge cost to the bank. We have a ton of people working on BSA/AML, and using subledgers and the profile tied to that subledger to the end user as a way to efficiently monitor for suspicious activity is one way to help build a business case around, you know, the investment that might not have a direct increase in revenue. Think about it more of an expense save, an efficiency save, right?
Yeah.
Instead of throwing people at it, let's use the technology to help us be much more efficient in, you know, the traditional risk management functions, whether that's BSAML, talk about credit risk, all different types of risks that the banks and fintechs need to monitor for. So
We've gotten a couple of questions that I'm just looking at. And because I mentioned FDIC insurance, I'll just go ahead and say. So one of the things about FDIC deposit insurance is up till now, the FDIC really only looks at in coverage payouts when a bank fails. So they go in on Friday and they look at some paperwork, and that's where that determination happens. Now, there are FBO accounts often run by brokers tied to the brokered CDs that they separately submit information to the FDIC. So the brokers are saying, hey, I've got some FDIC reciprocal or brokered CDs at this account, and they require insurance coverage. And that's documentation the FDIC uses when a bank fails. And so one of the issues is right now, in cases where funds are tied up and they're trying to figure out the disbursement of them, the FDIC, and because the bank hasn't failed, the FDIC isn't really kind of looking at the ownership information in the account. The way that, and the way that FBO accounts are structured is that if they are properly documented, each of the beneficial owners within that giant FBO account should receive deposit coverage. But one of the things is, like, do you really want to risk it when the bank fails? Do you really want to risk it when the fintech fails? Is this when we want to be answering these questions? And is this really when we want to be checking that paperwork? I've been thinking a lot about how the broker deposit rule, if fintech deposits were classified as brokered, does that mean fintechs get to submit paperwork to the FDIC that says, here's my paperwork? But these are reporting and reconciliation rules. Obviously, I think the FDIC feels that the existing reporting requirements are not up to where we are today in the modern banking environment. They're just not up to task, and there needs to be something that's a little faster, a little bit more accurate, probably. And the FDIC wants to, I think, feel prepared about this. I was kind of stunned to read that the FDIC doesn't even know how many banks have accounts that would qualify. So that's where we're dealing with right now. That's the information the FDIC has, is their best guess is up to 1,100 banks have this. And I also want to say that subledgers, what I think is so interesting about subledgers is this is a way to answer the question. This is not the only way to answer this question. It may not be the right way for an individual fintech program or a bank to do it, but thinking a little bit about what kind of infrastructure and reporting infrastructure and compliance infrastructure do banks need in order to be successful in the future? This is just one answer, and it has very clear use cases and kind of a known cost and a known benefit. So I think it's definitely worth thinking about as we think about compliance with this rule.
What is we talked a lot about the FDIC. What other regulatory agencies and whether they're responsible for the fintechs or the banks, like who else should be weighing in here besides the FDIC?
Well, I can tell you that the OCC and CFPB heads both sit on the FDIC's board and came out in support of this rule. Obviously, the FDIC, as the insurance agency, has the biggest vested interest in this rule. It remains to be seen really how other prudential bank regulators use their authorities, which I know the Bank Services Company Act gets thrown around a lot. How they use maybe those latent or dormant authorities to match the reporting and reconciliation requirements with maybe more direct supervision and enforcement. For now, outside of those statements, the the agencies haven't, the non-FDIC bank agencies haven't really indicated where they will go with this. I am sure that they would be interested in knowing which one of their charter holders has these types of accounts, because then they can maybe have more directed examinations, right? And we know that the OCC and the Federal Reserve are trying to build out their examination teams to have to figure out how they can supervise banks that are involved in novel activities a little bit better or more closely. So that's where we kind of are with this rule relative to everything else we've seen from bank regulators up till now.
One other topic that I think we've seen as adjacent to this FBO subledgering topic is things like MTL reporting. I know we had a question come in on that, but at Modern Treasury, we think about kind of the lowercase L ledgering problems that are adjacent to FBO subledgering. How do I also ledger my non-cash user balances, my operational user balances, payables, liabilities, that kind of thing. And what's nice is we can pull that in sync with balances that are pulled from Cross River's managed subledger. So we have a great historical partnership there. But there are so many reasons outside of this conversation, outside of FDIC regulation, or if a bank, there's a bank failure. You should be maintaining ledgers of many things that are going on in your business as a fintech. Like, it's crazy to say we're going to do this just because the FDIC is putting out this rule.
Yeah.
Like
Right.
Dana said, you need to display users' balances when they log in. You need to do your own reconciliation at the end of the day. You need to understand your profitability when you look at your fintech products. So there are all these reasons that you need to be thinking about your infrastructure aside from this FDIC topic.
Yeah, and I would just love to, piggyback off of that, because again, you can think about the FDIC and regulation generally as sort of the stick, right? The carrot of having subledgers is that, especially as we move into a world where potentially there's request for payment coming, which is something that Plaid is actively exploring and actively working on. We're going to move from a world where those transactional features, right, in these custodial accounts are primarily being initiated by, kind of Plaid as like the payment initiator, doing ACH debits for pulls, and then kind of lots of credits, right? We still do all the credits on the way out, but we're going to start to move from a world where every single way that we get money into the account is a kind of pull transaction, and we're going to start to see a lot more funds actually inbounding to the account as a result, via that RTP that comes as a response to the request for a payment. And so if you're not operating with subledgers that are fully routable so that the balances can be updated in real time, which is the whole point of doing an RFP, I'm not sure how fintechs or banks are going to get to participate in that, right? And like that is the future that Plaid is working to create, and that we want to see for our customers, is that we want them to have choice, and we want end users to have choice about all the different ways that they move money. Cards are always going to be in the picture. There's always a role to play for ACH debits. There's always a role to play for wires. But again, as Koji mentioned, we're very behind compared to the UK and Europe and other parts of the world with, kind of payment initiation models where end users can actually initiate real-time payments. But as we get closer and closer to making that happen, I mean, if you don't have the core infrastructure in place to support it as a bank, to support the fintech, how are you going to participate in that, right? And that's the carrot that I would emphasize for everybody.
Yeah, and I really like the idea of like, look, let's focus on the carrots here and all the reasons why this is going to help both banks and fintechs, and less about, oh, we have to do this because the FDIC is asking about it. This full conversation, should have been, this is common sense. This is the best way to do it, and we've got technology to do it, right? I think as we move forward into the fintech bank partnerships, it'll become very clear how technology can help us solve some of these kind of legacy challenges. I always talk about the legacy challenges in payments, but like beyond payments, it's banking, it's deposit holding, all of those things. If we think about technology, and that's what fintechs provide, whether that's to banks or banks providing some of that technology to fintechs who build on top of that. That's what I think we should all be getting excited about, and the positives here that the partnerships are driving forward. Just going through some of the questions. So third-party sender, there's an interesting one. I know Plaid has, and I'm going to use the notcha definition here of a nested TPS, and how they've used subledgers, getting a little bit away from the specifics of the FDIC rule, but like I think that's an example. And Dana, I don't know if you want to talk to that or talk to. I could cover how some other programs do it, but would love to hear your
Yeah,
perspective.
again, I mean, I think Plaid operates a few different models. We have kind of what we call originators who come to us to kind of move money for their own, own end users or even just their own kind of payment operations needs. And then we also partner with, platforms, right, who are embedding payments and initiating payment instructions on behalf of their customers. And right now we've kind of chosen to proceed with the model where we are directly onboarding those customers as a customer of Plaid. Again, we like the visibility, we like the transparency. We've built some infrastructure and made some investments to make it very easy to onboard. But we also have some customers who are working with us in kind of a nested way. And the point is, at the end of the day, we want everybody to have visibility into what's going on in the system, right? We would not want our banking partners to not be able to understand at the end of the day, who does the money actually belong to, how much in funds are there, and critically, like, what's the transaction history, right? So one of the things we do for all of our customers is as soon as we onboard the customer to Plaid, we turn around and immediately instantiate a subledger with Cross River as part of our onboarding, process with you. And the reason that's important is because everybody starts the system day one, at
Yeah.
time, time t equals 0. And then everybody has the same record as we go along, right? There's sort of no mismatch, there's no, seconds here and there can matter, right? But like at the end of the day, we're all reconciled from the very beginning, which allows us to operate, simpler models where again, our fintech customers are just onboarding their end users and transacting on behalf of their end users, but even to support platforms, marketplaces, nested, unnested, we can do it all because we actually have the capabilities from the banking partner that supports that visibility up and down the stack.
One other thing I'd want to call out in Cross River's system is routable subledgers or routable ledgers. So, in modern treasury, you have the notion of internal accounts, which can be bank accounts, or they can be routable ledgers. And again, these aren't actual bank accounts when you set up a routable ledger in Cross River, but they can support a lot of the same functions. So you can, for instance, receive a deposit and see actually who is that for. It's not just falling into an overall omnibus bank account and you have to figure it out after the fact. So those kinds of features make it a lot easier to actually reconcile properly at the end of the day.
Yeah. The other thing that I know, well, so first of all, the nested TPS had this debate internally. It's the notcha term. We think of subledgers as a way to effectively unnest or gain visibility to the end user's activity. So we can monitor, because oftentimes within fintech, there are different players involved. And I think from a bank's perspective, getting as close or one step removed from the person receiving the money or the person or entity sending the money, like that is very important from a monitoring perspective. The other thing, just throwing it out to the group if anyone wants to opine, we've talked a lot about FBOs within maybe the banking rails. They're also used in many card payments, whether that's acquiring or issuing. Cross River does both. I started my career was at First Data. There's legacy acquiring processors, there's legacy issuing processors who, I think they've been operating in some form or shape of FBO or custodial account, and the visibility to ledgers of whether that's a cardholder or a merchant is something that I think is not entirely clear depending on who's doing what within the ecosystem. I don't know, Kia, if you've got thoughts on that or anybody else.
I will say that as someone who likes to think of herself as a big reconciliation nerd, the payments thing is like, it's like a level, it's like a PhD level, whereas I feel like I'm in the undergrad, but I've actually been really fascinated to think about, if all these banks have a ledger that gets updated daily and has like appropriate technology that allows for a lot of this visibility, I mean, I would think that that kind of makes it easier for these fintech partnerships to have more, to have, backup partners, or to kind of send in direct payments. There's just a little bit more confidence, or problems can be identified a lot sooner, wouldn't you think?
Yeah, I think if we go back to, oh well, we mentioned it, synops in kind of what happened there. It's called out in the proposed rule. The visibility to the activity within the FBO clearly was not happening, and that could have been across a lot of different payment programs or payment modalities, if you will. So.
Yeah.
Okay, I think we're running up on time, and again, for those of you who
Wait, I have a question for you guys. Can I ask a
yeah,
question, please?
let's do it.
Do you think this rule is better or worse for fintechs and the interests of banks partnering with fintechs? Because I think there is a little bit of a retrenching here. And do you think like long term, it's better for fintechs that this rule exists?
Well, my perspective, it is a proposed rule. I think it's to the benefit of all of us to make comments and to see what the end rule looks like. I do think it will look maybe a little bit different than the proposed rule. I think it will probably be short term versus long term. I think long term, this is going to move the industry forward a great deal. Short term, there will be some pain, but there's already pain
Oh yeah,
happening.
like more
So,
pain, Keith,
right,
more pain than
exactly.
what
Like
we're
you can't.
going through.
Well, probably could get worse, but like,
Yeah.
I think we're already feeling a lot of the pain.
Yeah.
So I don't know, Dana or Koji.
Yeah, I think overall it's a great thing. I think the fintechs that were doing things right, if you were starting a fintech tomorrow, the fintechs that were doing things right were already thinking about things and thinking about how can they build things the right way. And over the past years, I think in the absence of a rule, both banks and fintechs we talked to were just kind of confused about like what's the best practice here? What's the standard? No one's really articulated it. And finally, it's in the form of regulation, but there's some articulation of what the standard should be. And I think that's going to speed up conversations, partnership conversations between banks and fintechs. It's going to make it easier for fintechs to build the right way the first time. Obviously, if you're a fintech that's operating today and you don't meet the regulations, there's a little bit of a scramble. But for everyone else, I think it's great.
Yeah, I mean, I'll say, from the Plaid perspective, like we see this as a net benefit, primarily because this is the kind of capability, right, and the infrastructure that we would expect from our partners. We've worked with partners in the past who didn't offer this capability. I've worked with banking partners in the past, in prior lives who didn't offer these kinds of capabilities. It was painful. It's doable, but it's painful to operate a payments program. Again, when your customers rely on you, not just, for the debits and credits, but to actually understand the kind of financial operations of their business. It's just much harder for everybody to do their job and do it right and create the product and the customer experience that everybody is looking for without some of these capabilities. So again, there's ways to comply with the rule that don't, require banks to offer subledgers. But at the end of the day, I think drawing awareness to this topic, not only because in a worst case scenario, everybody wants to have visibility, but even because, again, in best case scenarios, having this kind of, technological foundation sets us up for the innovation in payments in the future that everybody wants.
Yeah, and I would say, we see the bad news in the headlines, right? But what oftentimes is missed is many banks, they're working quietly behind the scenes to move in this direction, right? So it's not that they're reacting to a rule or the headlines. Many banks, they're not getting the headlines, but many banks are building these things out and understand the importance of supporting fintechs and supporting them in a appropriate manner. Okay, I did for those of you who are joined a little bit late, I'm clearly not Alex Johnson. Want to wish him well. He came down with a stomach bug, but did want to thank all of our panelists, Kia, Koji, Dana, for joining. Hopefully, it was an informative discussion, despite the fact that Alex couldn't be here. We'll have to get him back another time and get his perspective, because I know he has a lot of perspectives. As far as learning more, the formal Cross River view we've posted. I don't know if you can all see it in the chat, or if you go to our website, the insights piece around a more detailed view of subledgers and how we think about subledgers at Cross River. And obviously, both Plaid, Modern Treasury, and Kia's comments on the various different webinars, and I think it's all educational for everyone in the ecosystem. So thank you all for joining us. I do believe this will be recorded, and we'll be sharing the recording so you can share it with anybody who may be interested. So thank you all for joining. Kia, Koji, and Dana, thanks again.
For having
Thanks
us.
everyone for joining.
For having us.
Thanks.